Good afternoon, everyone. My name is Brian Overby. I am the Senior Options Strategist with OptionsPlay, and welcome to Q&A sessions. Our members have made it clear that these are very well received, and the opportunity to talk to myself or Tony has, warmed people's hearts, I guess, out there in option trading land. So if we have submitted a boatload of questions, there was an email that was sent out asking you if you have some questions, and I have those inside a Q&A box, and that's where I'm going to start. Now, there's also a chat box, and there is a Q&A box. So, I should say in an Excel file, but on inside the webinar platform, you will see a little question mark, and that says Q&A. I will try to address both of those boxes. I'll be working off of the Excel file with all your questions that you have in them, and then we'll also try to address some of the Q&A that is inside the box. Now, obviously, I don't have Tony with me today. He had other commitments at this point in time, so we wanted to at least get one event in because tomorrow is Juneteenth, so the markets are closed and not in celebration of the day, and we're not going to be doing our normal education event on Thursday. So we decided to do a Q&A box today. So without further ado, keep that Q&A box opened as we go along. If I need to share my screen, I will, but right now you just get to look at my ugly mug while I try to address some of these questions. And I gotta admit, I love OptionsPlay members because the questions are very astute. They're not annoying. They're straightforward, they're clear, they're clean, and I really appreciate that with all the members here at OptionsPlay. The first one we have Paulo, and Paulo says, which would be best recommended to generate consistent weekly income? All right, so there are a lot of ways to go about this. We have a lot of webinars that we have done in regards to the wheel strategy, which is more, I would say, in a retirement type account where you own a lot of stocks, you're selling calls to sell your stocks at a higher price, and selling puts to buy stocks at a lower price, dollar cost averaging into the stock. Now, that's a very viable solution if you want to try to generate weekly income. But the biggest play that has always been touted here at OptionsPlay is to look at short spreads. Now, we do the daily play, we put them out. A lot of times this is based off of Tony's research, and we've actually added a couple of overpriced and underpriced stocks in some of the watch lists. Tony actually just got that all put together. We're going to do some additions to those, but it has a lot to do with his research paper that he addresses every Monday morning. We have a webinar before the markets open. Tony gets in, talks about the markets in general, and then focuses on a few stocks that I will usually grab to do the daily play, week in and wake up. Now, obviously, it's a daily play, so not every single day do we come up with a strategy. If we get too many positions on, I will usually just close something or talk about a review. But I would say probably 3 or 4 days of a week, we come up with a daily play. Now, the reason why I'm bringing that up is because in the daily play, we do a lot of short spreads. We do a lot of short call spreads and a lot of short put spreads. Trying to get a decent, we are always doing something that's closer to the money where we're bringing in a lot of premium. And then that also kind of offsets the risk of that short spread. By bringing in so much premium, you can lower your break-even point on the trade. And that's probably I would say, from working over a year, almost a year now here with OptionsPlay, that is probably the staple trade. So, Paulo, if I'm looking at a strategy to try to bring in weekly income, the one that we probably talk about the most here at OptionsPlay is short call vertical spreads and short put vertical spreads. That's simple. Now, in the wheel strategy, most suitable for ETFs and QQQs and Google, or are we looking at Google, Apple, XOM, those type of stocks? So I guess the question is, if you're looking to do the wheel strategy, would you rather do it in an ETF or would you rather do it in an individual stock? And the biggest difference here, I'll put in most of the questions, the answer is it's kind of up to you. I prefer to do it on individual stocks, mainly because you get more premium. Now, you have gap openings and gap openings up or down, and that's much more likely in a single stock than it is in an ETF. So, in my mind, if you're doing single stock, because of the potential for gap openings around news and just major events, that is a more risky strategy, but you get paid for it because you get more premium when you do the trades. I do not mind just using the SPY or the QQQ. I don't think that that's a bad strategy whatsoever. They're fairly expensive underlying, so you do need to be able to buy 100 shares of them, and it doesn't allow you to, it's a little bit different on your dollar cost averaging and everything that you're doing in that sense. But I like the strategy for both of them. Now, personally, in my account, where I actually do a wheel strategy, where I have those positions on, I have both. I have single stock that I do the wheel strategy on, and I also use the SPY. I don't have any in the NASDAQ because, and when I'm looking at the single stock, I'm focusing usually on a lot of the tech stocks. So NVIDIA is one that I've had in my portfolio for quite some time. Also have looked at that trade, and we've done a couple of deep into money call options inside as part of the daily play. A couple of them got pinned and got them called away. But there you go. So lastly, last question that we have is, do you have any idea for zero DTE? And we have Philip online from OptionsPlay too, and he's in this webinar. He's going to post something inside the chat box, I think, that will give you. Tony's done a lot of webinars on zero DTE. I recently did one, but it was more focused on skip strike butterflies. It's an alternative to just doing zero DTE trades, and I focused a little bit more on earnings in that event. So I would go to Tony's if you want to learn a little bit more about it and addressed fully. Okay, I'm seeing a couple pop up in the chats. I'm also seeing some Q&A questions come in. Let me answer one more from the Excel spreadsheet, and then I'll come back and we'll try to address some of them in the Q&A box. All right. This is an interesting one, and YAW, I don't want to butcher the name, asks, is it possible to buy a leap put and use it like a poor man's covered call? In other words, I would buy a put and then sell a put against it, just so that I can explain that a little bit more. That means that I'm bearish on the underlying, so this is an alternative to selling stock short. And then if I sell the put, if that does get assigned, that means that they're going to put stock to you, and you are long that put option, which allows you to sell that stock. Can you do it as a poor man's covered call on a stock that you are really bearish on? The answer is yes, you can do that. It is a strategy, it's a viable strategy, but now with that said, I don't see it happen that often, especially if you're talking about going out 6 months or beyond on the long put strategy. Mainly because there's not a ton of people that just get short stocks and hold them for that long of a time period. Now, there might be some hedge funds that like to do that type of trading, but I very rarely see it in the retail space. And one of the things to be aware of, and this is what's probably the most important point of my conversation right now, is that if a stock is heavily shorted, if the stock is hard to borrow, and these are the stocks that you might want to buy these puts on and do this type of strategy, the puts will be very expensive. And it's just, it's something called put call parity. It deals with options pricing. But I think that is probably the reason why I don't see many people do that type of the poor man's covered call, if you will, using put options and getting bearish on the market. What are the two best strategies for income and portfolio growth? Two best strategies for income and portfolio growth. I want the best of both worlds. LOL. If I'm like I actually already mentioned, I do have an IRA account that I do the wheel strategy in. I'm a strong believer in the wheel strategy, or just doing covered calls. You don't have to sell the put on the other side. And to try, so you're more picking stocks than you are selling covered calls, right? In that instance. But that strategy, and I've known a lot of people that have traded options over the years out of all my teachings, and some people have never done anything but covered calls. They've never branched out into short put spreads and that's fine because they like the income from that, and that is their strategy. So that is the best way, I think, to use options to enhance a stock portfolio. And I'll go all the way back to the beginning, generate income. You will see inside the daily play that most of our plays that we are doing on single stocks are short put spreads and short call spreads. Or you could call them, that we mentioned in the strategy inside the platform, we call them vertical spreads. And the vertical spread is a little tidbit here, but that just comes from being down on the trading floor, which I used to work at the SIBO, which used to be called the Chicago Board Option Exchange. And whenever you're quoting something, if a order came into the pit, how you looked at the boards to quote it is where the namology came from. So if I have to look vertically on the board to get a quote for a spread, and you have to do that if it's in the same expiration, but different strikes, then that's where the term vertical spread came from. I like short call spreads, short put spreads. I think that those are the best scenarios, even to say credit spreads, implying that you're going to get a net credit when you do them. But I think those are some of the two best strategies. So let's run over to the Q&A. SPX is ATH. What is the best option strategy to trade for an SPX pullback? All right, so Trivo inside the Q&A box. I don't know what ATH stands for. Okay, and I see something about a daily play. If I'm looking inside the Q&A box, if I were to get bearish in the SPX and the markets are closed tomorrow, so I would look at doing a butterfly trade. That's the way that I would approach it. Now, that strategy doesn't pop up inside the options play all the time. I do bring it out from time to time, and I have done a couple educational events on it. But I like to do something that's called an open wing strategy, and it's an alternative to a long put spread, where you're just buying a put option and then selling a further out strike put option in the same expiration. But I don't know if I want to get into too much detail on the open wing. So I would say this, Trivo, the best strategy to look for a pullback at this time with where vols are at, it would be a long put spread or a bear put vertical spread. And the platform can help you with that. Usually the platform is going to go out 30 to 45 days, but you can also put your settings, how aggressive you want to be on it. I did a butterfly today based off after the announcement from the Fed meeting, and mainly because tomorrow there's no trading. So you get a half a day and a day, and if the market can land somewhere within the strikes, that is, excuse me, fairly wide. I should have hit mute. And so I'm about 20 points wide. Sometimes you can go 25 points wide. It's as much as you want to risk, and I just centered it around the money. And I did the Friday expiration. That's what I did around the Fed speak. And it was fairly well known that nothing was going to be There was not going to be any cuts in the markets, and then it was all about the conference call afterwards. Some people are saying Chairman Powell is being a little bit more hawkish, but you hear it both ways. Market went down, market kind of retracted, came back up, and we're just kind of hanging flat. So I think with the holiday out there, I think a flat trade is a solid trade in the SPX heading into the Thursday holiday, which we very rarely have inside our marketplace. All right. I saw one that popped up that I think I would like to address. Can you open the MU spread and explain it, and when to sell if prior to expiration? All right. So let me address that. That was in the actual chat box. If you can put your questions in the Q&A box, I'll try to address those in there. Let me open up the OptionsPlay portfolio. I'm going to move some things around, and then I'll share my screen. Let me know if you're seeing my screen when I share it. All right. I've had that issue before on one of my OptionPlay events, which shouldn't be an issue to me. I've been doing this for 20 plus years, but all right, here we go. Micron Technology. So right now the position is up 48% based off of the price that we were at. It is up $1.52 on the day. This was one of the stocks that Tony highlighted inside his research report, and that was part of the reason why I decided to do this trade on it. And in this instance, we are long the 117 calls and short the 130 calls. Okay, so this brings up a great opportunity to talk about what actually happened in NVIDIA, which we just closed out. So this is where I think the Q&A questions are awesome, and I love to talk about them, right? Micron Technology is announcing earnings on June 25th. This is part of the reason why our selection process, and Tony and I, we talk every Tuesday, and we go through the portfolio, and he gives me some input, and I give him some input. And we put together a sheet of things that we like to look at, just certain conditions, because every market's different, but there are some things. Micron Technology announcing earnings, and we think it's an undervalued stock. In that instance, we're going to do a long call spread. We're going to do a call vertical spread for a net debit. And because we want to give it some room to run. Now, we might ride this into earnings, but we're already up 50% on the trade. I don't want that earnings event if we're somewhere close. If we get up 75% on the trade, usually we look for about 100% gain, but that's like our general rule right here. I think this is a close. Oh, bearish trade idea today. Interesting that popped up. Well, we can go look at that. But if this happens on this underlying stock, we usually look to we usually look to double when we're doing long call spreads. So if we paid $4, we'd like to sell it for $8. That simple. Now, it's going to announce earnings. If we ride it through earnings, what I will have a tendency to do is adjust the long 130 call, because we have a huge run here, right? We're going from 117, and that's about where the stock was at, to 130. So you're talking about 13 points of room to the upside for this underlying market to go, which is another, we'll call it $8 of upside based off where Micron Technology is at right now. So if we went through earnings and things didn't necessarily pan out, and I think everybody's seeing my screen, right? We're all good? All right, I see the screen. Thank you, John. And I like to take this call option and roll it down, because the catalyst that might drive the stock up 13 points or almost 10% in this instance, with the stock at 121, has gone away. So unless there's another catalyst out there to try to drive the stock higher, then I like to roll it down and bring in some more premium, because what's going to happen here is that this option contract is going implied volatility is going to come out of it, right? So if the stock just kind of moves a little bit to the upside or even to the downside, I like to roll this from the 130, capture as much of the premium or close it out and get as much as the premium as possible. We received $2.66 and then roll down to the 125, saying, as I said in the actually daily play video, we don't want the cheese anymore. Just let us out of the trap. I don't care if it gets to 130 now. The earnings event has happened. I'll take 125. And that lowers your cost basis, but still gives you some room to run to the upside. And we just did that in NVIDIA. NVIDIA was just a real tough trade because it was in the news headlines. Still think that the valuation in NVIDIA is solid. Might actually come out and I'm thinking about if we get a little bit more, if we get another pop to the downside, coming out and doing a longer term call. So we talked about the poor man's covered call. This is basically the one position that we have in the portfolio that's going out 184 days on Charles Schwab. It's up about 20% since we put the trade on. Probably will sell a call against it here. Not that shortly, I would expect. I don't want to run into earnings as far as the financials are concerned. But our cost basis, this is a real option. We paid $15 for it, $1,518 plus any fees that you might have done to buy one option contract in Schwab. But I do think that NVIDIA is also a solid play as far as this strategy is concerned. Okay, so I don't know if I answered. Can you explain when to sell prior to expiration? Well, bottom line is if this ever gets to 100%, if we ever see, and I think it's Liz that's asking the question, if this ever gets to 100%, feel free to close it. Don't not do something because you haven't heard from us, right? You get alerts in the platform, and a lot of times I thought this one might be an alert saying that, we might close it, but it looks like we got a bearish indicator, probably because Microsoft has ran up so much. Relative strength is 9 out of 10. So we're on the upside of the move in Micron, and sometimes it would be a counter trend trade that would pop up, and that's probably what's happening right here in Micron. But you get these alerts, and these alerts will say you're at, you've reached our goal, you've reached 100% return on this. You can close it out if you would like. And feel free to do that, because realize the daily play is daily and we're doing it overnight. So I would like to react a little bit more during the day. And as a matter of fact, I'm working on that. I've talked with Tony about it and Philip, who's partaking in this event with me. And I would like sometimes to have an opportunity to just put out, let's close this trade. Because if you're trading volatile underlines, we did a couple in Tesla, and Tesla was really tough to do just on a daily play because, well, you obviously know the news and everything that's been happening in Tesla. So it's hard to just go one wait till the market closes and then decide what you're going to do in the Tesla trade the next day. All right. All-time high. Oh, I gotcha. Okay. ATH means all-time high. All right. Well, I didn't know that one. I just had to admit that I'm old and I don't know all of the acronyms that go on inside a chat box. Okay. Can you give recommended stops in the daily play email? I've tried the stops, but I always get lousy pricing due to market pricing. Would it be better to try limit stops, or is there another way people are doing it? John, this is from John, and this is in the Q&A box. This is probably the most questions that we get all the time. Stops are hard in options, and in particular when you have a little bit wider bid-ask spreads. Adobe is a great stock. We closed it out just recently, but it's a high price stock. And if you have higher price stocks, sometimes the bid-ask spreads are a little bit wide. And it just has to do with the dynamics of options pricing. So the question is, should I try a stop limit? And to me, I would. If I was going to do a stop order on a spread, here's how I would enter it. I would say, if the midpoint of the spread gets to this number, so it's going to be on the downside. So if, we'll talk about a long spread because it's simple. So you paid $5 for it, and if it gets to 250, I want to get out. So you put a stop in and you say if the midpoint hits 250, put in a market order to close. And you're going to get killed on it. Market orders don't really work in the options world like they do in stocks. So I would then send a limit order to try to close the spread at a dime or a nickel lower than my stop price. And the biggest thing about that is you're going to get an alert from your brokerage firm saying that order has been sent. Now, you obviously have to have alerts turned on, and most brokerage firms will send you an email saying that will happen. Some of them will alert you within the platform, but then at least you know that you need to look at it. And to me, that is just as important as getting the fill to get out, knowing that something happened in Micron or Microsoft. Well, Micron's the long call spread, so that's perfect. So something happened in Micron, and I should probably go look at my account and pull up my phone and see if I can adjust my limit. All right. All right, I'm going to hit mute and take a cough. Okay, back. Man, we got a lot of great questions in here. I wish I had time to address them all. Okay, so here's Charles. You guys did a great seminar on deep into money call strategy. Any plans to conclude some of these? Yeah, this one is the Schwab trade is one of them. NVIDIA, we did a strategy on. So I ask you a question, Charles, because Tony and I went back and forth. Would you want to have a separate portfolio of what we called outperformer stocks that we'd buy deep into money calls on, or is it okay to put them in the daily play? Would it be confusing to have two type of portfolios? And that's what the discussion is right now. But to be blunt about that seminar, Charles, is the markets went a little haywire, right? The markets are settling down a little bit, but we had the Liberation Day, and that added volatility, made it a little bit hard to pick underlyings that you want to get long on, especially because if you're picking these underlyings, you need to have decent liquidity in these. So a lot of the Mag 7 stocks, like if you're thinking of underlines, you're thinking of things that will trade that have a lot of volume, because the biggest headache of buying deep into money option contracts is dealing with the bid-ask spread. If bid-ask spreads were as tight on deep into money option contracts as opposed to stocks that are most of the times 1 cent wide, if those markets were as liquid as them, I don't think I would ever buy a stock. I think I would only buy deep in the money option contracts because you have limited and known downside risk. Like here's a great example. So with Schwab, we paid $15 for it. 15 divided by, well, at the time it was probably 80 bucks or so, but I'm going to say even 89 right now. Okay. So you're talking about 16% downside. Have you ever lost more than 16% on a stock? Well, yeah. There's a lot of them out there, right? But you can't lose more than that in this. If I was thinking about buying 100 shares of Charles Schwab, if I pay $15 for it and I got that option contract, and the delta on this option contract is actually, we might end up rolling this one because it's going to start to get to 1. If our delta gets to 1 on this trade, there we go. Then I will either close the position or roll it. I always want to try to stay in that 80 delta range on things, and our call option is a 75 strike, and we're at 89. Okay, so when would I roll this position down and take some of the risk off? Is if this gets to 1, which means we're way deep in the money, bid-ask spreads are going to get wider because we're deeper in the money, I will have a tendency to sell this and roll down and buy another option, or I guess it would be roll up, and buy another option that had an 80 delta and go back to the original plan, taking a little bit off the top and still having something that acts a lot like the stock. The delta means that it acts like 80 shares of stock. So Charles Schwab is one of those positions, Charles, funny enough. And and I plan on doing a little bit more. I just want the markets to kind of settle down. I'm a little bit nervous about the back half of the year. Everybody is. Nobody knows exactly. It's, you know, beauty is in the eye of the beholder. You can look at this and say markets are solid, employment is still strong, or you can say, well, inflation is a little bit scary and we don't know what's going to happen with the tariffs. So like it's really easy to make a bearish outlook and make a strong commitment for it, strong argument for it, and it's very easy to make a bullish forecast and make a strong argument for it. So that is part of the reason why I haven't looked at as many long-term trades, but I like the financial area. Tony talked about the financials a lot in his Monday show, and that's part of the reason why I picked Charles Schwab, which is still in, I think it's still in the research paper today. The research that Tony put out on Monday. Not sure if it's still in there. It was in there a week ago for sure. Okay. Before you enter your first trade each day, do you evaluate what you expect the market to do that day, like trend up, trend down, or neutral and choppy? Yeah, definitely. 100%, Mike. If I'm going to be entering trades and I'm going to be doing them on a daily basis, I want to do bullish trades in a bullish market and I want to do bearish trades in a bearish market. And I struggled at the beginning of the year. I was leaning a little bit too bullish after Liberation Day and stuff like that. So I struggled with that a little bit with direction, but especially if I'm doing a weekly trade, I usually like to enter them on Tuesdays and let me see what happens on Mondays. Mondays are the most volatile days overall, but for example, we've been talking a lot about short spreads. I like to do it on a Tuesday, maybe with a Friday expiration, or longer if you're looking at weekly trades. That zero DTE webinar that Tony did and put together is something that I don't know if you've watched it, but that he did a really good job with that webinar, as usual. Tony does very good jobs with a lot of his events. So what is your evaluation methodology, Mike? If I'm looking at, like, in other words, how am I interpreting if the market is bullish or bearish? Well, I'm just looking at charts more than anything. Especially in the SPX, the 200-day moving average is always an area of support just because so many people are looking at it. If you're doing short-term trades, it's more about the technicals than it is the fundamentals overall. So I'm usually just looking at volumes, and I do like to use the 200-day moving averages and the moving averages in general, even a short-term moving average, to try to determine if I want to get bullish or bearish on the next trade. I'm trying to think if there's an event that I could point you to that will kind of help out with that a little bit more. So there's not a lot. I think that's Mike. I'll put it this way. I think that's a seminar in itself, right? I can try to pull up graphs and try to say, well, look at this today and look at where the SPY is at and see if we want to get bullish or bearish. Today, I decided to get neutral because I wasn't expecting much out of the Fed and the fact that there is no trading tomorrow. So the rationale changes sometimes, right? Let's keep going on this side. Purchase your book. Thank you, John. I appreciate that. Options Playbook. You can buy it on Amazon. It's been out there for a long time. And I am writing a new chapter. I'm in the process. I'm going to do more on managing trades. Managing trades is tough because it's a lot like Mike's question about what would you look at in the marketplace to determine if you want to get bullish or bearish. CCI is also good. I always like to look at a momentum indicator too. Yeah. where can I find earnings recommendations? I know where the earnings calendar is, but cannot find the recommendations. Okay, Wim, I apologize for that a little bit in that Tony has decided, and he's added to his research paper an area called Earnings Navigator. And we used to send that out as a separate email. We're still trying to figure it out a little bit because it's new to us here at OptionsPlay. And it's not about the research that's actually inside the research paper, where we're focusing on forward PE, net margins versus the industry in general. The Earnings Navigator has more so to do with undervalued and overvalued and momentum. And that, so you're trying to find stocks that are like in general, the latest one that I did was in Chewy, where the stock just fundamentally didn't support the forward PE. And then it makes it tough that if they have an earnings report, they have to be perfect. And if they're not perfect, the market will go down. But that was a great example of it. It doesn't necessarily mean that if somebody misses, the stock's going to go down. Tesla was a great example of that just recently because they had their worst earnings report here the last time around. The numbers were horrible, but then Elon Musk got on and said, well, it's not about Tesla, it's about the robotics, it's about this and that, and the stock made a strong rebound, mainly because it had been beaten up. So even though the earnings report supported the stock being beaten up, and obviously you have the political scenario, the stock still went up in that instance. But the Earnings Navigator picked it as a stock, and based off of, and Tony's doing this all based off of fundamentals and math and momentum. That's all a part of it. Tony addressed it a little bit on our last Q&A session, which is available to you, but I actually don't know all the GUI that's behind the Earnings Navigator just yet. So if you pull up the research report, it's at the very bottom of it. Okay, Wim, that's where it's at. And I think that that's where it's going to live. But there are some weeks where there's no recommendations at all because we're running out of earnings, right? We're at the tail end. I mean, there's always companies that are announcing earnings, but basically earnings season is over with as far as the mega cap tech stocks and everything else that is involved. So scroll all the way down to the bottom of the research report. Visa was our bullish daily play today. 4%, good time to sell a bull put spread was our, well, I don't know if Visa has been in some of the research reports, and it's a solid stock. I'm looking at Try. Then I got to go back to the Excel spreadsheet and try to address a few questions there. But let's pull up Visa. Let's just pull up Visa, and I'll show Visa ordinary shares. Yeah, bullish trend falling has recently experienced a pullback within a larger bullish trend that may provide a favorable risk reward for a bullish trade. So Trivo, yeah, that is exactly how you would use the software. So we have still strong relative strength. But we have a pullback in the underlying stock. This is where I like to do credit spreads as opposed to doing a debit spread or a put vertical for a net credit. So if I click on high implied volatility, it's gonna default to about 40 days, and we'll look at let's modify this trade. Bid ask is only giving us an 86. It's defaulting to 44 days out. 340 to 320. That's a wide range, and I think so. The risk is 675 to 1,325. So you got to go a little bit wider, and I think that's why we're getting. So we're probably getting a little bit of a skew. We're going to have to pay up for that put on the downside. And you've been able to find a little bit better risk reward ratios. 1,325 divided by 675. One sec. Divided by 1,325. Okay, so we're talking about, yeah, that's not bad. So it went wider to get a better risk reward ratio. So for every dollar that we have at risk, we're looking to make 50 cents. It's 0.50 in this instance. And the platform will look to try to get a decent risk reward ratio. Now on this one, I might think about going 15 points wide. So, but you know, give a little bit lower score here on this trade, and I think it's mainly because of that, because you had to go so wide to get a decent risk reward. So let's go to here, 15 points, 575. Yeah, I kind of like this one better. A little bit less risk, but a solid risk reward nonetheless. And now we went up to a little bit higher score to 89. That is the trade that I would look at right there. Okay. All right. Let me address some of the questions, because I feel bad. People took time to put in those Q&As, but man, we got so many. Anonymous attendee says, follow up on the Schwab trade. All right. Let me answer that. I got to do a follow-up one. Could you have also opened a short call 20 delta, maybe 45 days out? Anonymous, if we're doing the outperformer where we're selling calls against it, like to look at 10 delta if you can get a decent amount for it. The premium is less as important because you didn't pay as much for the option as you would have for the stock. So we don't want to be assigned, and that is 100% the plan when you buy a call option as opposed to buying the stock. So I always give up premium to lower the probability of being assigned. Okay, but yes, and normally I'd be 30 days out, not 40, 45. If I go 45 days out, I'm going to definitely sell a 10 delta. Okay. Yeah, poor man's covered call. Inside my book, I call it the fig leaf, honestly. And the name is kind of taken off. And I coined that phrase inside the poor man's covered call. First of all, that's too many words. And you wrote it out that way, PMCC, because it's too many words. And then to go along with it, you're kind of covered, right? That's why we came up with the term the fig leaf, because you own the right to own 100 shares of stock. But if you get assigned on that short-term option, you got this long-term option that has a lot of time premium in it. And you can't just exercise, you probably don't want to, and give them the stock. So if you're going to get the stock and you need the money, you're going to have to sell that, you're going to have to buy the stock, and then you're going to have to deliver the stock. So I called it the fig leaf. You are covered as far as the brokerage firm is concerned, but as far as reality is concerned, you're kind of covered. It's not as simple as a straightforward covered call. And you can, optionsplaybook.com, if you just actually type in fig leaf, type in fig leaf option strategy, if you want to make sure that you don't get something nasty on your computer. All right. Schwab. Okay, so then I feel bad because I should look at I can't pronounce. I'm bad with names. When you're putting an example for a call debit spread for directional movement, would you recommend using out of the money short puts to put this custom trade for a credit? No. Okay, here's a trade that I did that I did on a different platform, because I do webinars all over the place. But luckily, and this one was just pure luck, but saw something in the chart, wanted to get long oil, and it was more about the WTI futures chart. Oil was trading 63 something a barrel. Here was my trade to try to address your scenario. I would do this, but I don't. It's too complicated to sell short puts to buy call debit spreads, right? I think that that's too complicated. So I did the exact opposite, and I'll see if I can get, we'll get a P&L on it. This trade is already played out. I'm looking to try to close it this week. I wanted to close it today. I'll probably close it Friday. I don't really want to continue into the weekend because oil is strong. This actually ended up flat today, but USO was around 70 when I put the trade on, and now it's at 82. Okay, so here we go. Here's the trade that I would look to do. I would look to go out about 30 days is what I started with when I initially put the trade on, and I'll modify this, okay? No, I don't want to buy long stock. I'm supposed to be here. Here's where I'm supposed to be. All right. So if you want to get bullish on oil, you got some volatility. If you know, I don't mind this trade just in general, but you got weekend risk. You know, who knows what's going to happen over the weekend with the conflict over in the Middle East. So you got to be prepared. You got to be nervous about it. But you're seeing a real high options play score, and that's mainly because we're also looking at the IV ranking, 72 out of 100. So we're definitely on the high end as far as USO is concerned, as far as volatility is concerned. And going out 44 days, I did 30 days. So that's the July 18th expiration. I don't mind the 44 days. That's normally what we would default to. Selling an 82, buying the 74. So that's two. Yeah, I think I did 6 points. Yeah, see, look at the risk reward here. Now, here's the total difference. Let's get the number. Yeah, this is solid as far as risk reward is concerned. So rewarded to risk 375 divided by 425. We're at 0.88 risk reward ratio on this trade. You're almost getting as much premium as you are risking, and you're out of the money, right? We're selling the 82 and the stock's at 82.27. As a matter of fact, I bet you we get a decent risk reward even if we go down to 81. I don't even think we have to sell the 82. And let's make this go down to 73 if you want to be a little less risky. Yeah, you're still getting, I like that right there. If you want to get bullish on oil. Now, USO, it's based off of futures. It tracks oil fairly good. It's not, it's just like almost any ETN that's out there. It's never perfect. Gold is actually a really good one that tracks the price of gold. But this is a very interesting daily play because of the volatility skew that is out there. And this is why, well, here it's that simple. This is why this gets a score of 100, and the trade that we just looked at got a score of 88. It's just got a better skewing of the prices, which gives you a better credit and a better risk-reward ratio if you're putting on the trade. Now, here's what I did. I put this on, I let it run for a couple of days, and then I came back and I added a call. And I did the 90 call. Why did I do the 90 call? Because it was free. Because it was the same amount of as that I brought in. Now I'm curious to see if this will be flat. A little bit of a premium. It looks like you have to pay 38 cents, 370. We pay, yeah. So we're paying a small net debit for it. So if I'm selling that put spread, to go all the way back to your initial question, I don't mind selling put spreads to buy calls on something that I'm extremely bullish on. And I was bullish on USO because of the chart. So I put this trade together before the conflict happened. I was planning on being in it longer, but it only took a week for it to play out because of the trials and tribulations in the Middle East. But here's a great example. And man, that was that whole scenario. If I was going to write a seminar and we're doing it all off the cuff, that is exactly why you need the OptionsPlay platform, right? This just shows you why you're getting that type of score that you are when you're looking to sell short put spread. Because the risk reward ratio is more solid in the USO, and I don't even remember what the other one was we were just looking at. All right, now I'm going to go and address, let me address some of the sheets. Okay, I'm going to stop sharing because I got to get to the Excel spreadsheet here. And I want to address some of the questions that are in the spreadsheet. I didn't even hardly touch on them. I only did a few. My plan was to come back, but the discussion was rolling. All right. How do I close Adobe Play? Okay, how do I close it? You just close it. Are you asking about, well, if it's inside the platform, you just literally click closing trade and then you send it. And if you're doing it on a paper trading basis, you can do it even if the market's closed, and you can close those out, just so you know. All right, somebody's confused about the MU play. Please see a separate email with photos. Okay. All right, we'll look at that. Liz, we'll look at that. Philip, look for a question on MU, and I'll be happy to try to address it on Micron. Okay, can you please go over how to roll a winning trade with momentum? And this is Armind. Armind, don't make it too complicated. If you have a winning trade that's got some momentum in it, close it out and open a new position. I prefer doing that, especially if it's a long call spread or a call debit spread, and you got the momentum to the upside. I'd like to just work it as two separate spreads instead of saying I want to sell to close, buy to close, sell to open, buy to open. You can do that, but that's just tough to go over it. If you're looking, okay, so I think I need to go back into options play. Let's pull it back, because both these trades, both of these questions, I think are really addressing the paper trading platform. So, 1 second. Okay. If you have that question about MU, we do not see it. Could you resend it? Can you resend it to support@OptionsPlay? And I put my do not disturb back on. So I will log back in. It looks like I got logged out. That's what happened to me. And I will share my screen, and we'll talk just a little bit about the paper trade and the portfolio trade. Okay. Share desktop 2, and I'm sharing. All right, got it. If I am in, well, I think actually I have, if we go to portfolios, I think I have the Chewy trade in here still. Let's see what pops up. Yeah, okay, so here's the Chewy trade. And if you want to close that trade, and this would be, I had this in as a portfolio that I put together called earnings. And here was the Chewy trade, because this was 100% an earnings play. And if you want to close it, you click on this, and it goes over to here, and it shows you your position in general, but there's a big button that says close position, one says roll position. If you want to roll the position, if you click on it, it gives you that you're going to buy and sell this option contract, the shorter term one, and you're going to sell to open and buy to open a longer term option contract. And I'll just accept what is there. So if you did want to roll the position, you would click trade, and notice that it's showing this is buy to close, this is buy to sell to close, and this is buy to open and buy to open. And then you could add that to the position, and that would roll that position. So I'm going to do that right now. I'm going to click this add position, and these are the different portfolios that you might have. Mine is called earnings, and I'm going to add that. And you'll notice that we'll be out in July now. and it did all of that and it rolled that position on out. So you can do it that way. I like to just close and reopen, but if you're doing it in the paper trading platform, the OptionsPlay paper trading platform makes it very easy to do by doing that trade. Now, if you just want to close the position and you have it in part of your portfolio, just literally click close the position. So we rolled it. Let's hit trade now. Add this to the position. Notice that this says close. It doesn't say open. Add it to the position, and that position goes away. All right. Yeah, Chewy gets interesting if it breaks below here. Actually, I got an alert set in my account that if I can break below this recent high, notice it came right down and touched it. Wonder if I put it, yeah, I clicked, this is the support and resistance lines, and it added that line right there. And if it comes down and it can break through that level, it gets a little scary in Chewy. And I would get short Chewy just because of a break to the downside. Because if you break through there, this is in play all the way down to 30, right? So notice that here's the earnings, a strong move down, came right down to that most recent high, kind of validating that recent high. But the fundamentals are still tough. I mean, if we just look at the PE ratio right here, we're trading at 46 times previous earnings. And, because that's the static PE. The forward PE is about 78 times earnings. So they're just not, the earnings aren't there. The earnings growth is not there. Oh, okay. All right, Liz. Thank you. Thank you for the webinar chat. I appreciate that. Brian's in the webinar chat. I'm a momentum scalper and the trade intraday. I usually trade by buying in the money calls and puts with a weekly expiration puts. I know there must be a safer alternative to minimize risk if the stock doesn't have the big move I anticipate. My trades usually last 15 minutes. Oh, nice, Brian. Well, Brian, thanks for sharing that. I find that interesting. I don't know if there's a question that's in there, but yes, moves in 0 DTE options, you're talking about almost 10 times the risk. If you're in the money and it moves and you're short options, it hurts real quick. If you're out of the money and you buy a call or a put and it doesn't move, time decay just kills you. I don't trade. If I do a great example is legitly the butterfly that I put on today. I sold a 20-point, or I bought a 20-point wide butterfly, paid I think $1.25 for it, centered around the stock, and the SPX was right around 6,005, and this is just pulling it out of my head. And this was ahead of the Fed meeting, anticipating that there was going to be less movement after the Fed meeting than anticipated. Implied volatility was up. It made that butterfly very cheap. Maximum upside would be 20 points, paid $1.25 for it, and I'm just going to let it ride. Let it go until Friday, and then I'll trade it on Friday. Markets closed a little bit under 6,000. So I'm still within my range of my butterfly as far as that is concerned. And it's just sitting there decaying over this holiday. And I'll probably get out by 10 o'clock Eastern time on Friday morning. That is my favorite 0 DTE without any major event, right? I do like to do skip strike butterflies around earnings events. And we're looking to add some of that type of stuff to the platform as I get more of a hold on what we're doing here at OptionsPlay. I did a webinar on skip strike butterflies. We're way back at the beginning of my tenure here. Oh, actually, look at the 0DTE webinar that we talked about. We actually did on the show a live trade, but earnings were out on a stock, and it worked out almost perfectly. I can't remember, but you go back, it wasn't that long ago. Philip, I think you have it. We could probably put that one in the webinar chat box. I think you mentioned that you saw it earlier. We'll put it in the webinar chat box. Yeah, okay, Brian. What's the way to mitigate risk? On the shorter term 0DTE options, the only way to mitigate the risk, Brian, is to do a spread. To do that spread. If you're just doing calls and puts, very hard to mitigate that risk. I don't even know. I've never came up with a way to just mitigate the risk if you're just buying options outright. I'm thinking, could we sell something out of the money? Could we do an iron condor around it? But then you're also just adding so many legs and commissions. And in particular in the SPX, there's additional commissions because the Chicago Board Option Exchange charges extra commissions to they charge extra commissions just to get quotes on the S&P 500 index, the SPX. You got to pay up extra for those quotes because it's a single listed index. That's why everybody quotes the SPY. Here is the link to the 0DTE webinar. Thank you, Philip. When you say a straddle, Brian, are you going long or short the straddle? I'm looking at your chat. Answer that, please. So you want to go long the straddle. Okay, straddles are hard in that the math of the marketplace even says that long straddles are hard in that you usually need about a 1 standard deviation move in either direction in order to make money on a long straddle. And that's because of the way they are priced. They're priced based off of that type of information. And that's from Sheldon Natenberg's book, Option Pricing and Volatility. He talks a lot about long straddles in there because it's some insight into what the marketplace thinks the underlying can move. And hence the term expected move. Around earnings, when you look at a long straddle, that gives you look at the long straddle for the shortest expiration, and a lot of people will say, well, the Apple's expected to move 5% after earnings. There's no regard to direction, but all they're doing is looking at a long straddle. So to me, you're playing the over-under game. Do you think the market will move more? Do you think the market will move more than the marketplace is anticipating? Or do you think it will move less? So here's my setup for long straddles. And we did one on a Q&A, sure. And I've done this before with stocks that are in the headlines. And I've mentioned a few long straddles where I did a lot of them over times where when Boeing was having issues with their planes not staying in the sky and all that great tragedy that was around that. But were the planes going to fly? Were they not? The news headlines weren't known when they were going to come, but they were coming. And so I felt like volatility wasn't priced correctly for the potential of news headlines. And so I like doing a long straddle and even a long strangle from time to time. IWM, we talked about this because tariffs are a big deal to small cap stocks. So the IWM is the Russell 2000 index. And when the market was at, the last time we were around, let's pull this up and see if we can go back that far here. Market was at 200, talked about doing a long straddle because of the potential move throughout this whole range back up to the upside. So that was all the way back here. And we need to go a little bit longer on the chart back. And you can see the channel where that is at. Yeah, it's not going to go back far enough. But the long straddle in IWM is probably 12 bucks going out 30 days. And if we center right around I want to be at a precipice, right? So you got a little bit of support and resistance in here. Let's click on this. Yeah, it's not really there. I think it's more so a little bit more down here. But so if I do a long straddle 30 days out, July 18th. Yeah, it's right around 11 bucks. $10.68. I find the IWM to be something that's interesting to do long straddles in, because look at this move just over a month. April, you're going from 180 all the way up to 209, and then let's go in this direction from 209 all the way up to 240. So if you're doing long straddles, you want to see areas of the chart over the same period of time that have the premium that you're paying for it. So if you're going to pay $10 for a long straddle, over the last month or two, has the stock made a $10 move? And then if you go back a couple of years ago, there was a really well-defined channel in IWM, and I did some long straddles in that channel. Whenever it would get to the bottom of the channel or to the top of the channel. And yeah, but I don't like long straddles overall. I don't. It's tough. It's tough to find underlyings. This just happens to be one that I'll do one in from time to time. And I actually did a daily play in it once. Way back in the beginning, I did a long straddle, and I don't think that one worked out. And it was weird because every other one that I had done in the IWM up until that point had. All right, I'm gonna have to divert. Let's go back and look at a couple of more questions that we have, and we're getting close to time here. Thank you so much for all the great questions inside the Q&A box. Wow, great turnout today. Really appreciate it ahead of a holiday. Everything's turning up roses, I guess. Let's stop sharing. All right, back to me. Here we go. Fernando. Okay, so Fernando is asking about stop loss orders. You want stop limit orders. You don't want stop market orders. Stop limit is what you want to do, and hopefully you're going to limit it based off of the midpoint of the underlying stock. I don't have a day job, so if I'm staring at the markets all day long. I should say that I do have a day job, obviously, but if I'm constantly got the markets open. So if I get an alert on a stop, very rarely does that just fill at the midpoint. I almost always adjust it. By the way, I just want to let you know. But I a lot of times just like to get the alert on. I'll make alerts on underlying stocks, and if the stock actually hits the price, then I'll go look at the option trade. So there are times when I like to base them off the options, and sometimes I like to base them off of the stock. But that is a real issue to have a stop loss in on a spread and going to get it triggered and then send it to the market. I don't like that move at all. I'd rather get just an alert that the midpoint was hit on your stop, and then enter the order over your phone if you have to. But I don't like market orders on spreads to close sent to the market. Okay, a call vertical spread is placed on XYZ, so a fictitious XYZ. The price of XYZ blows through the upper level while the trade still has a month or more to expiration. What are the options to manage this trade? Vertical call spread. All right, Michael. If I have a short call spread on, and the stock blows through my short strike and goes all the way up to my long strike, right? First of all, that is a time where I would just think about closing it anyways, mainly because you're selling an at-the-money option contract on your long option. Now, at OptionsPlay, what we always say is that if it's worth double what you received, so if you put it on for $2 and it gets to $4, you close it and get out. And we usually just close the trade. Now, if you're doing this trade and you want to adjust it, you can roll the position, but whenever you roll the position, you're taking a loss on the option contracts that you initially placed, and then you still have the risk of the marketplace. So I prefer to just close when the position has moved against me, as opposed to roll it. Now, I have done webinars, and this is more so trades that I've done in indexes, where you do a short spread and you roll it into a butterfly. So if the short call spread goes against you, see, like I said, this is a whole webinar in itself, especially adjustments. And that's the hardest thing. Adjustments are so tough to talk about on this is just one simple question of 10 words, right? But if I do a short call spread and it does move against me, you got to buy that call spread. I'm not quite sure how to try to explain. It would be above and beyond the scope. But here's what it is, Michael. And you'll have to look for webinars that I've done on this topic. Is I like to start and look at butterfly, or either start in a butterfly and roll into a spread, or start in a spread and roll into a butterfly. And you'd have to have an example to be able to show it. And sometimes it doesn't work. If it's really close, especially if you're trading daily or weekly options, it's very hard to adjust them. You need time premium to be able to adjust them. I don't think I gave you a great answer because there's not a great answer, I guess. I usually will just close them, take out the trade, put on a new trade. And usually if the market's moved that much against you, I kind of want to think about that underlying, right? And so to me, I still just would rather close the trade. And if I want to go back in that underlying, let the market move a little bit more and establish where it's going, and then try to figure out a reason why I might want to get back in that trade again. Terrell says exit strategy for leaps. If I'm in a long leap option, and I'm not sharing. Okay, if I'm in a long leap option like we are in, and I'll just say it, I'm not going to share my screen and go back to it. I don't think I'm sharing my screen. For example, if we're looking at the Schwab position inside the daily play, which is really a long deep in the money call option, the strike on Schwab is 75. The stock is at 90 today. If the stock hits the strike, I get out. And it's the same concept of being in that short spread. That short spread, the market goes against you and it goes all the way up to, you got your short option, which is all your risk, and then you got your protection that you paid for. I'm selling my protection and getting as much juice as possible because the stock has moved all the way up to that strike, and you're then selling an at-the-money option contract. Same thing on a leap strategy. If I put this position on and the market comes all the way down to my strike, I don't care where the time frame is, I'm probably going to sell it. Because first of all, my outlook is wrong, right? I'm not doing this on stocks that I want to buy and hold for the rest of my life. I'm not Warren Buffetting the stock. I'm doing it because I see strong growth. I see a lot of the things that Tony talks about in his Monday show with his research paper. Strong fundamentals, strong near-term growth that you're expecting. And if it doesn't work out, Well, if it gets down to my strike, I'm going to sell it. Another way to look at it too is that I put the position on. In Schwab, we looked at, what did we say? 16%, I think, was the total cost of the stock that we put on. And I don't mind saying that if I'm down 10%, I'm going to get out. And I don't want to lose more than 10% on any of my leap strategies. And that would take away the days to expiration. I'm just going to get out if I'm down 10% on my relative to my option contract. So we put it on for $15. If the or for, well, let's go here. If I say $15 and I do 10% of $15, so like $1.50 on the trade, right? Then I would get out at that point in time. If that's what my position is and that's how I want to address it, I would do that. I kind of look at it as if I have this long leap strategy on, I've already minimized my risk, right? I've already done that by, if I'm looking at it relative to buying 100 shares of stock, I'm going to spend $1,518 as opposed to spending, I think the stock was at, we'll call it 80. I think it was 80 because we bought the 75 call. I think the stock was 80 something. So as opposed to spending $8,000. So I've already managed my risk. I like to just let that ride in general. And if it hits the short strike, I get out. That's simple. Because, or I'm sorry, not the short strike, it hits my long strike, it hits my 75 strike call, and it comes down to that range, then I just sell it and get out. Because I've already minimized the risk on the trade by doing the deep into money call option, and I'm doing this as an alternative to owning the stock. This is one way that I can keep cash in my portfolio. I'm not going to buy as many leap options as I possibly can with my $8,000 that I was going to spend to buy 100 shares of stock. Right? I'm going to buy a leap or maybe two and give myself a little bit of leverage on that position. But by doing that and not spending that whole $8,000, I'm managing my risk on the trade. I think I addressed that better. So if you look at the risk relative to buying the stock outright, that's the way that I would approach these deep into money call options. All right. All right. I think this is a follow-up to the Delta conversation about deep in the money call options. And here is the question. Should you sell higher Delta covered calls and roll if the target is crossed? You can, but that means you got to be active in the marketplace. And if you're going to do that, I would roll my position when the stock got to the strike price. I would do a preemptive roll. I would not let the stock get to go beyond the strike price on my call option. So let's go in, let's just do Schwab. Okay. So let me think here. Let's go this way. Let's go Schwab. And this will be the last question, everyone. If I have a Schwab position on and I were to sell a call at this point in time, income, well, I'll just put it down here. Let's just take this trade and modify it, and we'll just sell it. 85, midpoint, 58 days out, probably go 30. I'd go somewhere between 30 and 44 days. I don't think there's a lot of juice right now in Schwab. Yeah, the IV rank is really low. We're at 13. So we're not going to get a lot of premium. 30 days out. We're going to probably have to go 45. 88. Let's look at like a 90. Not bad. 95. That's not too rough. All right, so we're bringing in a buck. Buck 50. Where was the delta? 31. All right, 20. 0. Why is it saying 0? It's not going to be 0. $0.48 is a 15 delta. 63 at the mid. All right, so that's not, this would be something I would look at. If I was doing Schwab and we were doing the outperformer strategy, we're at a 15 delta, bringing in 63 cents. 63 cents, so on $1,500, we're talking about 5% of the premium that we paid for the call option. That's a solid amount of premium that you're receiving, going 44 days out, selling the 100 strike, which gives you 10 points of upside, and bringing in 63 cents. Not a bad trade on a financial stock. Not a bad scenario. Now, someone else said maybe we should do the 20, and I don't mind that, but then adjust. So here's a 23. I don't know why that 20 is there. Let's look at this one. So now you're bringing in $1. You're bringing in about 40 cents more. 97 is obviously feasible within the next 45 days, the stock to get there. And if I did this trade, I would do a preemptive roll. So let's send it to the earnings. And watch this. No, portfolio, I'm sorry. Well, actually, let me adjust that. So if the market came up and hit my 97 strike, I would want to do it when the market hit 96, because you don't want to be assigned. So about 96 and a half, I want to think about doing this. If it gets to 97, I'm definitely doing it. I don't want the stock to get to 98. And then what I want to be able to do is go out to the next strike if I can and get it done for as close to a net credit as possible. So you would go to the August 15 strike and you would go up to, let's say 107. We would want to get more than that. I don't know why. Maybe these strikes aren't available. Yeah. No, we need to get more of a net credit. Okay, but you get the concept. I'm not gonna. But this is and inside Options Playbook, if you go to the managing section, I always say don't let your option get more than 1 or 2% in the money, because then it's just you're paying too much time premium. You're not getting the benefit of buying and closing an at the money option contract and then selling an option contract that is also at the money or just a little bit out of the money. So don't let it get through your strike if you're going to do that. I would prefer in this scenario on the Schwab, I would much rather get the 60 cents and get a lower delta than get $1 and take on the risk of being assigned and having to roll the position. Because every time you roll the position, realize you do lose money on that option contract that you're rolling. You are losing money. It's like the blackjack concept, right? If I bet $5 and I lose, the next time I'm going to bet $10, and then I can break even, right? And that's just the way to look at it. I'm not sharing. Okay, that's fair. All right, let me share. I'll share and I'll finish it with that. share desktop 1, desktop 2, share. Okay, so let's close this one real quick because this made no sense that I did what I did. 97 here. This position I just put on, let's close that position and we'll trade it. And we'll add to that position and we'll close that one out. Okay, so now if I go in and we click on this and we do Schwab, let's say that we sold the 90 strike call. That's what we want to do. So we got this call option, we're going to modify this. And it's now at the money, and we'll say we got 15 days remaining to expiration, and we sold the 90 call. 165, and it's 89. This is a perfect example of a preemptive roll. You're not quite to the 90 strike. You are worried that you're going to get it called away because we got a deep in the money 75 strike call option that goes out another 168 days. Here's how we would want to roll this if we put this position on and now it's in danger. Okay, so let's trade this and add it to the position. All right, now I can go inside the portfolio and I will do just earnings, get rid of the daily play. And here's our trade. This is as of today, but we would have put it on for less of, it would have been a lower cost basis, right? Now it's at 165. Now we're in danger of being assigned on our, oh, of course I did the long call. Dang it. Why did I click long? Okay, then we close the position. So in this scenario, this would have been a buy. We would modify this. Roll position, okay, and so this one would have been, the 90 would have been a buy, and we'd go out another week, and now we'd want to sell, oh my gosh, we gotta go out more than that. We gotta go out 30 days to sell something. Yep. All right, so if you do it when the market gets to 90, this would be, the 90 would be a buy, this would be the sell, this would be the trade. You would be buying to close the July 3rd 90 strike option contract for $1.65, and then selling to open the July 18th 92.50 strike option contract for $2.11, and you would bring in 46 cents to do the trade. And that's how you would roll preemptively before it gets to the strike. If you let this stock get to 92.5 and you want to try to roll and get out of the money, first of all, you're deeper in the money, so that's a little bit tougher to do. And second of all, you got a lot of intrinsic value to add to this premium. So you need to go further out to make up the time value you got to add to it to try to reduce the extrinsic value that's on that 90 call. I hope that was helpful. Even though I started with a long, that should have been a short call position. We can add it. It'll be kind of stupid if I do, but let's add it. What does it happen over here? Yeah. I added an extra 190 strike call. All right, that's it, everyone. That's it. 15 minutes long. Thank you so much for everything that we did today. And yeah. Have a very enjoyable market holiday tomorrow. Go out and have some fun. And we will see you the next time we do a Q&A meeting. I think the Q&As are great. We get so many great questions. I do think we should do more. I enjoy doing them. And thank you for stopping in, and we'll see you in the daily play. All right. And Till the next time, I always like to say, may all the option contracts that you buy expire in the money and all the ones that you sell finish out. Thanks for tuning in.